and thanks everyone for joining the call. Um, we discussed just a moment ago to what extent I ought to tell the story of Menhaden. We don't know how many of you know us well and how many of you are kind of new to Menhaden. So I'm going to sort of whip through the origins and what we've been trying to achieve during the last 9 years. So we launched Menhaden in 2015, in July 2015. We set out to try and emulate, I guess, the best of RIT, which is a vehicle I've known all my life. And Jacob Rothschild was very close with my father. And in fact, one of the partners in Menhaden, Graham Thomas, was previously chairman of the executive committee at RIT, which is kind of like chief executive. And what I think what RIT sought to do was to combine world-class risk management. They've always had a really good investment team with a world-class network, which was Jacob Rothschild himself. He was able to get them into deals that other investors weren't able to access. He had tremendous Rolodex and tremendous insight, and it's worked over decades. And one of the reasons why it's worked, I think, has been the structure. A closed-ended vehicle allows you the ability to take on illiquidity, to do more esoteric things, to run perhaps a more concentrated portfolio, which doesn't necessarily apply to RIT, but it does to us at Menhaden. It allows you to flex the asset class, the asset mix, according to how you see the world. To behave, I guess, in essence, a little bit more like a family office than open-ended fund structures can, or time-limited GPLP private equity structures. So what we wanted in Menhaden was to apply a climate slant or a kind of green slant, which we refer to as energy and resource efficiency, to a concentrated portfolio of high quality investments with great risk management and a good network. It took us, I guess, a sort of a year to find our feet. We had a pretty rocky start. Luciano joined as CIO after 1 year and really drove home the message that our investment policy should be centered on quality and valuation. So a kind of Buffett school traditional approach to stock picking and also to private opportunity selection. Let's only invest in companies that have strong balance sheets, that have cash flows that we can predict with some degree of comfort. And most importantly, companies that have strong competitive positioning because they benefit, for example, from high entry barriers. Companies that have pricing power, which is important during inflationary periods. Let's really buy quality at the right price in a concentrated portfolio within this broad theme of energy and resource efficiency. And it was really Graham that coined that term, energy and resource efficiency. If there's a green industrial revolution taking place in the world, which undoubtedly there is, the heart of the story is one of the more efficient use of resources and moves towards circularity of resource use. So that gives us a pretty broad universe in which to invest. So really, it's Luciano, Teddy Pybus, who's our analyst, and me that run the business. And investment decisions are taken unanimously by the investment committee, which is chaired by Graham Thomas, who's with us kind of half a day a week and so on. The board is independent. So the board outsources management of the portfolio to us in the management LLP. So we're a third-party management company for the PLC. Chairman of the board is Howard Pierce, who had a long history in public sector pension funds. Soraya Chabarek runs CQS, recently sold by Lord Heinze. It's a big investment management business. Barbara Donoghue ran the family office of a member of the Fisher family that owned Gap. And Ian Cheshire is a FTSE 100 legend and was also among the first FTSE 100 chief executives to spot the opportunity in energy and resource efficiency while he was at Kingfisher. So he kind of gets the theme. So we invest globally, but really it's the US and developed markets, but big emphasis on North America. We're long only. Investment trusts can do almost anything, but we choose to seek the best balance between risk and reward across large cap, high quality public equity. And to the extent we invest in private credit and private equity, we look to co-invest with leading participants. And we'll talk more about that in a minute, but we've got great relationship with firms that include KKR. We co-invested 4 times with them very successfully, with Apollo, with TCI, with Perfin Apollo, which is an unrelated firm, is one of Brazil's leading infrastructure investors, and so on. And so the same investment thesis applies to private opportunities, which at the moment make up about 25% of the portfolio, has been as high as 40% and as low as 10%. But it's an even higher bar, and we only invest where there is a lead investor that we can rely on, and where we can access those deals on some kind of preferential terms. So we tend not to pay much or anything in the way of management fees, for example. So that's this idea of combining a good network with good risk management. And we're conviction investors, with an emphasis on quality, and wanting to access opportunities at the right price. That does limit us somewhat in terms of investable universe. And so we really run a concentrated portfolio in which each position really matters to us. Each position is known very, very well to us. So we tend not to have more than 20 positions, and the highest conviction ideas can be significantly more than 10% of NAV. At the moment, the highest positions have 12, 13%. And we buy everything on a 3 to 5 year time horizon. We're long-term investors, very low turnover. Sometimes we go a whole quarter without adding any new position or removing any position. So it's a patient approach. And it's a patient approach that aligns with our own priorities personally. And we between us, Luciano and I, and our respective families, and also Teddy and Graham and the kind of home team, own nearly 30% of the shares. So there's a strong alignment of interest. We're managing our own money here. Menhaden is a bit like our listed family office, in the sense that shareholders in the vehicle are effectively investing alongside us. I don't know the extent to which you want to hear about, the kind of acceleration in disruption. It's kind of obvious. Look at the composition of the Dow Jones Industrial Average in 1990, or even in 2000. None of them are still there. And the rate of disruption is accelerating with the emergence of increasingly dramatic technology innovation. And a lot of that disruption is taking place in the field of energy and resource efficiency. The artificial intelligence, applied to data centers, massively reduces their consumption of electricity, and so on. That's happening in every industrial sector. We're living in an age of massive disruption in which competitive moats are under siege, and so we like to invest in businesses that display, oligopolistic or even monopolistic characteristics. The North American freight railroads, for example, being a prime example. You can't just magic a new freight railroad in North America. It's almost impossible. So bearing in mind, growing risk to terminal values because of some of these things, rapid innovation, climate change, so on, dramatically evolving consumer tastes and expectations in an age of social media, we want to invest in companies that we think have a better chance than most of still being around within our investment time horizon. And so hence this Venn diagram, which was first drawn on the back of an envelope in the low coffee table in our office the first week that Luciano joined us. This is how we're going to build the portfolio. This is how we're going to think about things: quality, valuation, and the efficient use of resources being the theme that interests us. And it's working. It's working, and we'll come to our performance in a moment. But since we first drew that Venn diagram, we've produced almost 11% annualized performance net of costs, which makes us, then, according to the Association of Investment Companies, the number one top performing flexible asset class investment trust in the UK market over 1, 3, and 5 years, and the number one environmentally focused investment trust. What we're doing is working from an investment management perspective. It's a kind of rough cut. It's really hard to slice and dice the sectors that we look at within industrial efficiency, and in any case, we're not top down. We don't think about it that way. We don't think we must find something in waste because we don't have enough in that area. It's very much a bottom up approach. That being said, we've been asked to do it enough that here is the breakdown of sectors that interest us. So digitalization, sustainable, well, you can read it for yourselves, but those are the areas in which we've invested. And clean energy is perhaps an interesting one for the discussion part of this call. We've long been concerned about the commoditization of electricity generation, there's zero marginal cost once a wind farm or a solar asset is built. And so we think that's going to exert powerful downward pressure on power prices, and therefore clean energy generation is an area that's decreasingly of interest to us, although it's a place in which we've made lots of money during the last few years. So here is our portfolio as at end of August. You can see updates from the weekly fact sheets since then, but not much has changed. I wonder, rather than asking Luciano to jump in now and pick at random one or other of these positions, if I can invite those on the call to ask questions about them. I think that's a better way to engage Luciano on any one of these. If we unleash him to talk about these at length, we'll potentially be here for the whole day. So if you have questions relating to the portfolio, I encourage you to ask them, because I think that will be a good use of all of our time. The private investments you see are listed at the bottom there. Avantis and John Lang are both co-investments with KKR. They're both in infrastructure investments, cash generative asset-based deals. And TCI is the sort of friends and family secured credit fund created by Sir Christopher Hone at TCI, sits alongside his dramatically successful hedge fund. So we'll come back to portfolio then shortly. In summary, it's working. We're producing great returns. It's everything we wanted it to be, this vehicle, with the exception of the share price discount to NAV, of course, which is something that's affecting all investment trusts. Are we witnessing the end of investment trusts? Possibly. I don't know the answer to that. I don't think anyone does. That is the bit we didn't anticipate. Is the share price of these investment trusts, especially smaller ones, trades at a discount to NAV very often. That aside, this is where I want my money invested. Everything I can get my hands on, I've put in Menhaden. If I could get my hands on more from our family vehicle, which I can't, it would be in Menhaden. This is exactly how I want to manage my money. We found a formula that works. Luciano and I get on incredibly well. Graham is a great chair. Teddy is a great analyst. We're churning out this performance. We're looking at great private deals. We could do more private deals. It's working. And I guess we'll want to have a bit of a discussion around some of that. These are the. Sorry,
I was just wondering whether it made sense for me to jump in and read out a couple of these questions as they come in, given that you didn't.
Sure. I mean, we're at the end of the presentation. Let me just touch on this last two slides, and then we'll go straight into a discussion, because I think that's the most interesting part. I'll just finish these last two slides. These are our private deals. This is all available in the website, but we're good at this. We're good at selecting the best private equity co-invests and getting in these deals, on attractive terms. We make money doing these things. We'd like to do lots more of them. Addo was a co-invest with Apollo. Callison was KKR. Perfin Apollo is a different Apollo in Brazil. Electricity infrastructure in Brazil. Transmission. Excelio was KKR. So here it is, and note the volatility. We've done this with low volatility. This has been a pretty steady recovery from the low point 9 months after launch. It's better than a 10% compound annual growth rate, and you won't see a NAV graph like that in pretty much any other investment trust. And here is the discount, which you will see reflected across the entire investment trust sector. And it doesn't seem like more liquidity in the portfolio or greater size offers much of an inoculation against that in the current environment. It has narrowed recently a little bit. You have seen our share price run up in the last couple of weeks. So the outlook, relentless focus. We're extremely disciplined. Luciano is a credit investor. Credit investors, the good ones, are extremely disciplined, much more concerned with the return of their capital than the return on their capital. So we are absolutely focused on our investment strategy, and we don't deviate whatsoever, even if I do tend to present venture ideas and distressed credit ideas and all kinds of things. None of it lasts more than 5 minutes in any investment committee discussion. So we're extremely disciplined. Performance is working. Our kind of medium to long-term goal as the manager is to compound our way to scale. greater scale means greater liquidity, and hopefully greater liquidity means a narrower discount, especially if conditions improve for investment trusts generally. Now that's kind of the default, medium to long-term plan. The expenses are coming down. Your total expense ratio has dropped pretty neatly from above 2 to about 1.7 or something since we launched, and that will continue to come down as we get bigger. Yeah, why don't we jump into questions? And you'll see here some slides on the individual portfolio company. So I'll jump to those to the extent that they appear in the questions. So Q&A. Here we have got a question on performance. Let's clear this up quickly. I thought you said made 11% per annum. So yes, it's a good point. Since inception, so I mentioned we had a rocky start during the first year. So during the first year, we were down 20%. That was 2015. Since Luciano joined and we put in place the investment strategy that I've described, we've compounded a little shy of 11%. But yes, it's somewhere around 6% since inception and 11% during the last 8 years. US political landscape in terms of environment policy, solar and wind, and then Avantis. So how do you want to take? Should we look at the portfolio and then go bigger picture?
I think we can answer the questions. I mean, in terms of Ocean Wilsons, they support the sale of Wilson Sons, absolutely. If we think the problem with Ocean Wilsons is it's twofold. First, the discount. If you think the discount of Menhaden is high, the discount in Ocean Wilsons is approximately 50%. The Brazilian asset is a very good asset. In fact, our rationale is effectively we own that asset for free, or you either own the investment portfolio or you own the Brazilian asset. The investment portfolio, though, it's too diversified. It's like more than 80 positions. The performance has been slightly above 5%. This lacks conviction. This basically that portfolio needs to be restructured. Once the sale of the Brazilian asset goes through, if that happens, we expect that the share price would materially increase. Although we don't assume that they will distribute the cash to shareholders. They'll probably either set up a new vehicle with a similar mandate to Hansa, or potentially merge it with Hansa. Are we interested in renewable infrastructure and digital infrastructure trusts given the big discounts on asset quality? It depends. The problem with renewables is that, as Ben mentioned, there's quite a lot of there's a lot of new supply coming in. We think that the best way to play this sector is to invest in the developers. And Exilio was one, Avantus is another one, and that answers the other question as well. Avantus is another opportunistic deal with KKR for a solar developer in the southwest of the US. Obviously, that considering the election in the US and that Trump is not a big supporter, might impact the prices. But ultimately, what drives the prices on those is yields, right? So the yield curve, effectively, you see a correlation between the yield curves in the US and rates, and the correlation is very, very high. In terms of environmental policy, well, I mean, the Trump is a good news for business, but not good news for the environment. We think that solar and wind are the cheapest options now, and there should be a priority for the government. However, the issue is obviously from an investor's perspective, the fact that effectively energy becomes a commodity. And you have this concept of infinite supply because you can put solar panels pretty much everywhere, and makes it not the type of businesses that we like to invest. We like to invest in monopolies or oligopolies, as Ben mentioned. And if you look at if we can go to the portfolio, Ben, on the page of where we have the portfolio. you'll see that effectively we have different buckets, right, of investments. The one would be like the infrastructure part, which, you know, Ocean Wilson's with the ports in Brazil, Canadian National, Canadian Pacific, Union Pacific, and Vinci. They are all like effectively hard assets, where there's very little operational leverage. You know, in the case of the railroads, there's been some economies of scale due to precision railroading in the last few years, but now the story is effectively of, you know, they managed to increase margins, and now there's going to be a story of probably volume growth going forward. But there's very limited operational leverage in those. Whereas in the other half of the portfolio, let's say the Alphabet, Safran, Airbus, Microsoft, and Amazon, you can see that in that there's massive operational leverage, higher risk of disruption, obviously, but we feel very comfortable that the end game in 3-5 years in all of those is very clear, and we see very high returns for all of them. I think that's just an overview. In terms of the time frame for Avantus, we think that it's probably going to be around 5 years, and in terms of returns, obviously that will depend as well on the US elections, but we think that, you know, the demand for energy seems very healthy in the next few years in terms of with electrification, cars, and data centers. So we feel that it's quite defensible. So don't know if there's any other.
There is a question on fees.
Justify.
Luciano.
Well, this I think ultimately there's a question about charging fees on the NAV rather than the share price. Well, I think ultimately there's very little control we have over the share price. We have control over the portfolio, and I think we've done a very good job since March 2016. You know, we've been advocating in the past for buybacks. The board is independent, and we don't control their actions. But we think that, you know, when ultimately the NAV, you know, we think that the discounts, it's not a permanent event. Eventually, just to give you some examples, I think Impacts was trading at a premium until very recently, and now it's trading at a discount. I think eventually the market, with the changes in the sector, and when the UK becomes more, you know, when the government announces the budget, that Europe, you know, not only UK investors but European investors will start looking at the closed-end investment trust, and perhaps realizing that the opportunity is there. I mean, closed-end investment trust, they always outperform open-ended funds, and precisely because of the discounts and the fact that, you know, that you can do buybacks. Well, there's another question about if the management team and their family owns about 30%, they are considered to be concerned party and so prohibited from increasing their holding percentages without triggering a bid. That's correct, unless you actually get a waiver from the FCA doing buybacks, and you can only increase through buybacks. You cannot increase in the market, in which case you would have to launch a tender offer. So I think we answered kind of all this. Ben, if you want to give like another overview and some remarks.
Yes, there's a few more questions that have appeared in the bottom.
There's one about Exilio. We sold. Well, we exited. KKR sold to Brookfield, and we got, as Ben showed on that slide, we made approximately a 13% IRR.
Yeah, thank you so much to everyone for joining the call and for your interest in Menhaden, and especially to those who've been shareholders. We're really doing our best for you as investment managers. There is a big, we're discussing, what we can do about the discount, like every other investment trust in the UK. Thank you so much, Neil, for organising this.
Yep, no, I think that's right. And thank you everybody for listening in today. I think what we've learned is that this is the top performing fund in the flexible and environmental fund in NAV terms since inception. The fund invests in a concentrated bucket of quality businesses, public and private, with this resource efficiency bias. The share price discount, it's an opportunity at this time, and the brokers to the fund are Deutsche Numis. So please do contact them for interest in accessing shares. The ticker is MHN. And for any other questions, please contact myself or your usual Frostro executive. Thanks very much, everybody.